All right, everyone. So, Bismillahirrahmanirrahim. Assalamu alaikum, everyone. I welcome you all to another session, which is for SBR past papers. Now, we are continuing our practice on section B, and section B will consist of, remember, section B will consist of 2 questions. Each question will be worth 25 marks. In either of the 2 questions, question 3 or 4, you can have some marks for current issues as well. So, we need to make sure that we nicely attempt these type of questions. Remember, okay. So we are starting off this particular question, which is Leria company, and this is a past paper of March 2020. So this is available in your Kaplan examination kits as well. This is question number 39 in your examination kit, and also March 2020 examination past paper. All right. So we have this case in front of us. All right. So we are going to attempt this question as if we were attempting this question in a real life examination. All right. So when I see this past paper, I see that the whole structure goes around like it has some background, 2 lines of background. Then it says there is a case of stadium sale, lease back. So by reading lease back, I have it in mind that some portion of IFRS 16 sale and lease back transactions might be applicable here. All right. And improvements. So sale and lease back is here and improvements. Okay. So I see this should be applicable here. Then I see that there is another case which is for television program content rights. Now, when I see television program, I see an intellectual property. I see an intangible asset coming to us. All right. And when the examiner says this is content rights, in back of my mind, at least I have some hints that maybe, I don't know, but IS 38 may be applicable here. Now, once you have got the initial idea that what accounting standards may be applicable in such a scenario by just looking at the headings of the question, I would always suggest that you go on to the requirements first, since by the time you reach to question number 3 or question number 4 in your real life examination, I can reasonably assume that you would be short of time. So it's better that you go to the examination requirements first, so that you get to know what exactly you need to find out in each of the scenarios. And yes, there is one more scenario which is regarding players contract cost. Again, I believe this will be somehow related to IS 38. All right. So I see the question requirement structure. There is one 13 mark portion, requirement number A, and then there is 12 mark portion for requirement number B. Now, each of the two is a requirement of discuss, which means that I would try to go both sides, right? I would try to go both sides. There might be multiple accounting standards being applicable here, and I would try to talk both sides, the positive ones and the negative ones. All right. So starting with the requirement number 1, requirement number A. So it says that discuss with reference to IFRS standards, requirement number 1, whether the directors can classify the stadium as held for sale at 31st October 20x5. So now we know from requirement number A's requirement number 1 that at least held for sale is one of the areas that examiner is testing in this question. Now remember, do you guys remember the criteria for classifying any non-current asset as held for sale? Remember, I used to tell you that there were exactly 5 requirements. The asset must be available for immediate sale in its present condition. The sale must be highly probable. The price at which the asset is marketed must be reasonable in relation to fair value of the asset. The transaction must be executed within 1 year. Exceptions should be, of such scenarios that are uncontrollable for the organization, and there are no significant chances of significant changes in such a plan. So then you can classify an asset as held for sale. Now, for the first requirement, your examiner is merely asking that whether you know the requirements, yes or no. So you need to know IFRS 5 in and out, and also you need to link it with the scenario so that it is possible to get the required marks. Next, your examiner asks you in part number 2 of A that Leria company's accounting treatment of the crowd barrier improvement at 31st October 20x5. So by looking at this, I get a point of view that Leria company has proposed a certain accounting treatment. for improvements in the crowd barrier in the stadium, maybe. Yeah. So I just need to form an opinion. I need to discuss with reference to particular IFRS requirements, that whether the proposed accounting treatment is correct or not, on what aspects it can be considered as correct, and on what aspects it cannot be considered as correct, right? So I have to talk both sides. Then the requirement number 3 is basically about the principles of the accounting treatment. So I need to discuss the principles of the accounting treatment for the sale and lease back of the stadium at 30th November X6. So all in all, I get the idea that requirement number A is merely related to the stadium that we just saw as requirement number 1, right? Yeah. And also I get the opinion that requirement number A, all parts more or less, they are much more related to the rote knowledge of accounting standard, right? So if you know the accounting standard by heart, it would be very easy to score marks here, because when your examiner clearly asks you the requirements of held for sale or the principles of accounting treatment for sale and lease back, I see that there are low hanging fruits in front of you. You can, at least half of the marks can be easily achieved just by outlining the requirements, and then the latter half you can achieve just by linking those accounting requirements with the scenario. All right, so now let's do it. We'll start with requirement number 1 as it is. Okay, I won't be reading requirement number 2 at this moment, because then my mind would be too cluttered and I won't be able to focus on a particular scenario and answer it in a better manner. Okay, so let's go and read the first areas. It says that background is that Leria company is an internationally successful football club. So when you think about football clubs, a football club is basically all about owning a particular stadium, owning the rights of certain players, and then you compete in certain leagues and matches, and then you earn ad revenues, stadium revenues, and so on and so forth. So this is the type of business you need to memorize. All right. Leria company is preparing the financial statements for the year ending 31st of October X5. Now, this is very important that you note year ends very properly. So your accounting year end is 31st October X5, which means that your year start would be somewhere, 1st November X4. So 1st November X4 to 31st of October X5 is basically your accounting year. It says, but is currently facing liquidity problems. So the club is currently facing liquidity problems. And when a club is facing liquidity problems, it has to let go players like Ronaldo, Messi. It has to go of them because they cannot afford such heavyweight players. Either they have to increase their revenue or they have to sell their belongings. This is how the field actually works. So now your examiner says that Leria company has entered into a contract regarding its stadium, whereby it will sell the stadium on 30th November X6 and immediately lease it back. So definitely this is a sale and lease back transaction. You have entered into an agreement to sell your stadium and then you will lease it back on 30th November X6. So definitely this is a salt transaction, sale and lease back transaction. All right. The examiner goes on to define that the directors of Leria company wish to classify the stadium as a non-current asset held for sale in its financial statements for the year ended 31st of October X5. So since the entity has made a decision that the economic benefits from this stadium will be principally be recovered through sale rather than through usage, therefore the company is of the opinion that this stadium should be classified as held for sale in the financial statements for the year ending 31st of October X5. And from a principal point of view, from a logical point of view, I have no worries with regards to that. Principally, if you have decided that you are going to recover the carrying amount through sale rather than through usage, then the principles of IFRS 5 initially have been met. But yes, you must remember that under IFRS 5, there were at least 5 conditions that had to be met before this particular classification could be made. So I'll repeat those criteria again. The asset must be available for immediate sale in its present condition. The sale must be highly probable. That is, you must be actively looking for a buyer. And in this case, we see that the Leria is certainly actively looking for a buyer, but rather has actually located a buyer and has done a contract with it. So the sale is literally highly probable. Now we need to see if the quoted price is reasonable in relation to fair value of the asset. The transaction should be executed within 1 year, and then there are no chances of a significant change in this plan. All right. So the directors of Leria company, it says that the directors of Leria company wish to classify the stadium as a non-current asset held for sale in its financial statements for the year ended 31st of October X5, as they believe the sale to be highly probable at that date. All right, so the sale is also highly probable at that date. And certainly I agree with the fact that the sale is highly probable at that date because the contract of sale has already been made. So certainly the sale is highly probable. It says that the sale contract requires the disposal of the stadium for its fair value of $30 million. So the contract has been made at $30 million, which is also the fair value of the stadium. And for Leria company to lease it back over 10 years. So the stadium will be leased back for 10 years. All right. Then it says the present value of the lease payments at market rates on 30th November X6 will be 26 million. So examiner has also pre-calculated the present value of lease payments, which is PVMLP, and that is 26 million pre-calculated. Now, sir, why do we actually need PVMLP? If you remember, the sequence of solving a salt transaction requires the measurement of PVMLP. It is, I believe, step number 2 in the salt process. Yeah. So this PVMLP, the pre-calculated PVMLP, is definitely very important for you. It says the market value for a stadium of this type has not changed in several years and is unlikely to change in the near future. Since the market value is not likely to change in the near future, so there I see less chances of this sale transaction going wrong over the period. The stadium is being depreciated 5% per annum using the reducing balance method. Reducing balance method at 5% is being followed. All right. So at least I have read the first paragraph. And if I were you in the examination, I would go back to the requirement number 1 and just see what the requirement actually was. So the requirement was that requirement number 1 was whether the directors can classify the stadium as held for sale at 31st of October X5. So the first requirement actually asks you if you can classify the stadium as held for sale. Now we will just draft an answer. Remember, this is going to be a very rough answer. I'm not going to draft like I would be doing in an examination scenario. I expect that you would be drafting a very good answer from your own side and then asking me for a feedback, right? But still, I would be drafting rather a reasonable answer for you guys to refer. All right. So, all right. So I would say Leria Company, March 2020, requirement number A and requirement number 1. The question asked me whether I can classify this stadium as held for sale, yes or no. Now, remember, we always had a 3-step process for answering any question. And that was, we always started with the relevant IAS and IFRS. And then we tried to mix up with the scenario. We tried to perform application, explanation, right? Explanation. And then if required, we would go for conclusion. Now, since this is a discussion requirement, I won't suggest that you go for a conclusion. Had it been an advice requirement, whenever the requirement is for advice, you should go for conclusion. But since this is just a discussion requirement, the examiner is not actually asking you to conclude something. Therefore, I would advise that you should stick to these 2 steps where you write down what the IAS or IFRS says and also link it with the scenario, and that is more than enough. All right. So I would just start with the accounting standard. And you do you remember through my lectures what were the two basic words that you use to start any question in SBR? Two golden words. Do you remember? And these two golden words are basically according to. These are my favorite words to start an examination answer. So I would say that according to IFRS 5, a non-current asset should be classified as held for sale if the carrying amount is principally be going to recover through sale rather than usage. Now remember, you would be using a keyboard to make your answer, and therefore you would be requiring much less time as compared to what time I require to complete this answer. All right. However, certain conditions must be met. Certain conditions must be met. And what were these conditions? Now let's go for it. The conditions were, number one, now remember, IFRS 5 actually has 4 conditions. I treat them as 5 conditions. The number 1 condition would be asset is available for immediate sale in its present condition. In its present condition. Now, I would like to combine the two requirements in one, so that I can save time while drafting this answer in front of you. The asset is available for immediate sale in its present condition, and the sale is highly probable. I would here link it with the scenario. Here, since the contract is already formed, therefore the transaction is certainly highly probable. All right. Done. Then the requirement number 2 was, now I would be skipping some words here just to save time. The requirement number 2 was the asset must be, the quoted price must be reasonable in relation to the fair value. In relation to the fair value. Is this requirement met? Yes or no? I would say yes. The asset is being marketed. The asset is being marketed at fair value of $30 million. So that part is absolutely correct. Now the third requirement was the transaction must be completed. The transaction must be completed within 1 year of classification. Now we need to check if this is practically, applicable or not. If we go back to the question, my friends, and we go here We had an accounting year end of 31st of October X5. We are making a classification as held for sale on 31st of October X5. If the transaction had to be completed within 12 months of the date of classification, within 1 year of the date of classification, our cutoff date would be 31st of October 20X6. Whereas if we see that it is written that Leria company has entered into a contract regarding its stadium, whereby it will sell its stadium on 30th November X6. Now, here is the catch. Here is the catch. Although the rest of the requirements are being met, but since the transaction would be ultimately closed, beyond the 1 year requirement. Therefore, the held for sale criterion is not met. Right? The held for sale criterion is not met. In this case, however, the transaction of sale is not expected to be completed within 12 months of classification. That is, you can also refer the date to make more relevance. That is November X6. Therefore, the held for sale criterion is not met. Hence, held for sale classification cannot be made. Right? Now remember, since this was a discussion requirement, you need to talk both ways. So we did discuss that requirement number 1 and requirement number 2 of IFRS 5 was met, but since the requirement number 3, in our case, the requirement number 3 or 4, whatever you may call it, since the requirement number 3 was not met, therefore we are saying that held for sale classification cannot be made. All right. You don't need to go for the last requirement of IFRS 5, which says that there are no significant chances of a change in plan, because it is irrelevant. Since the classification has already failed on the second last step, therefore we don't need to waste our time in our examination question writing the requirement number 4. Okay, so we need to save time there. All right, I hope that this is very much clear for you. So we took half a page in front of us and we rightfully answered this requirement. I believe this is sufficient if you're answering such a requirement. All right. Also the requirement number 2. So, okay. So the requirement number 2 is related to the accounting treatment of the crowd barrier improvements, right? So we haven't read anything regarding to crowd barrier improvements till now. That means that we need to study the question a bit further. Let's go back to the scenario. So we have done this para at the very least. Okay. Now let's continue. It says that in the year to 31st of October X6. Now remember, our accounting year end is 31st of October X5. If your examiner is referring to 31st of October X6, that means the examiner is referring to the next year. It says in the year to 31st of October 20X6, it is anticipated that $2 million will be spent to improve the crowd barriers in the stadium. Now just imagine there is a Clasico match, football match going on. And, the crowd barriers were not strong. So many of the crowd members came into the crowd and it was a security issue or so on and so forth. Now, the football club has decided that they are going to improve or renovate the crowd barriers. And for that, they are going to make a $2 million expenditure in the next year, in the year to come. All right. The expenditure has not yet happened right now. So therefore, a question of capitalizing this cost or, charging into P&L does not arise. Also, can you make a provision of this $2 million improvement cost? I mean, I don't think so. Because either this $2 million cost should be a legal requirement in order to create a provision, or it should be a constructive obligation upon you, and then only you can create a provision. Now, let's see what examiner has actually done. It says, it says that there is no legal requirement to improve the crowd barriers. Remember, under IS 37, you can only create a provision if three requirements were met. There must be present obligation, probable chances of outflow, and then a reliable estimate. Now, we do have a reliable estimate, and there may be a probable outflow as well. But the main point is, do you have an obligation to incur this $2 million expenditure in the next year? Now, it can be a present obligation arising as a result of past events through by act of law, or through a constructive obligation, that is through past practices and published policies. Now, there is no legal obligation there, but we need to see if there is a constructive obligation. Is there any published policy to renovate the crowd barriers? Now, let's read. It says that Leria company has incorrectly, whoa, your examiner is helping you out. It says that Leria company has incorrectly treated this amount as a reduction of the assets carrying amount at 31st of October X5, and the corresponding debit has been made to the profit or loss. I mean, your examiner has made an accounting entry that P&L debit 2 million. The worst case accounting that I would have thought in my mind would have been that I would do P&L debit and provision for future cost credit. The worst accounting that I would have thought of would have been this. But your examiner or the accountant of Leria company is even moving one step ahead. They are saying that we have made an entry, P&L debit 2 million and asset credit 2 million. The cost of improvement has basically been deducted from the carrying value of an asset. And that is for sure not true. In any circumstance, this accounting entry is not justified. This is a wrong accounting entry. So if my examiner asks me that if you agree with the proposal of Leria company for this accounting, yes or no, I'm going to say certainly no. Even IS 37 is not applicable, since remember, I need to discuss the IFRS as well. This was the requirement number A. So I would say that the accounting proposed by Leria company is absolutely wrong. And further, according to IS 37, even the provision cannot be made. Okay. It also goes on to say that at 31st of October 20x5, the carrying amount of the stadium after depreciation. So on our year end, the carrying amount of the entire stadium after depreciation and deduction of the crowd barriers improvement was 18 million. Now remember, this 18 million is after deducting the crowd barrier improvements. After deducting the crowd barrier improvements, the carrying value is 18 million. And we have just discussed that this deduction is absolutely wrong deduction. That means we need to add it back. And therefore, the correct carrying amount of our stadium, including crowd barriers, would be 20 million rather than 18 million. All right. So we'll go back to the requirement again. And the requirement says that you need to discuss with reference to IFRS standards, Leria company's accounting treatment of the crowd barrier improvement at 31st of October X5. Now, if we go and try to write a reasonable answer for this. So, my friends, this is part number A and requirement number 2. So, I'm just going to draft a short answer for you, okay? So, Leria company's proposed accounting requirement, proposed accounting treatment is not justified on any grounds. On any grounds, this accounting treatment is not justified. It could have been argued it could have been argued to create a provision for the future cost, but then again, criteria of IAS 37, you need to refer the accounting standard, remember, so that your examiner knows that you know about the requirements of the accounting standard, okay? So then, but then again, the criteria of IAS 37 needs to be reviewed. All right. In this case, crowd barrier improvement is not a legal requirement, is not a legal requirement, and there also seems no published policy, no published policy to create a valid expectation of such improvements. Right? So I'm just, shortening it up. Therefore, a provision cannot be recognized, right? So you just mind my handwriting for some seconds because I'm doing it pretty quickly. So the writing standard is not very good. Okay. So a provision cannot be recognized. All right. Then I would suggest that you calculate the corrected carrying value of stadium is 18 million plus 2 million add back, and this would give you 20 million carrying value as at 31st of October X5. All right. All right. And further, you remember, you just include this in your answer as well, that P&L charge of 2 million would be reversed. While you're drafting a proper answer, you need to also put this very clearly that 2 million charge that has already gone into P&L has to be reversed. All right. All right. So I believe that if you draft an answer on these lines, this would be more than enough for you to handle this requirement. And now for part A, there is another requirement which says that you need to discuss with reference to IFRS standards the principles of the accounting treatment for the sale and lease back of the stadium at 30th November X6. So you need to discuss the principles of sale and lease back transactions. And obviously, since you're referring the IFRS, you need to also calculate you need to also perform the sale and lease back transaction. Now, I'm very sure that most of you already remember what sale and leaseback requirements were, but I would still like to revise it for you. So, according to IFRS 16, sale and leaseback transactions were to be accounted for using the following steps. So there were basically 4 steps, if you remember. So step number 1 was to determine if IFRS 15 had been met. IFRS 15 has been met. In my opinion, in this case, the IFRS 15 is already met. Yes, you see, as per IFRS 16, first you need to determine in a sale and leaseback transaction scenario if the sale is actually occurring, yes or no. So the requirements of IFRS 15 of satisfying a performance obligation, is this being met, yes or no? If it is being met, then only you can account for this transaction as a sale and leaseback. If it's not a sale, it's not a sale and leaseback. All right, as simple as that. So since the contract is made, and the sale is probable. Remember, you are answering on 30th November X6. Therefore, the criteria for sale have been met. Right? So had the criteria of IFRS 15 been met on 30th November 20X6, that means you would have received a sales proceed which was equivalent to the fair value of the stadium. And if we go back to the question and we see what was the fair value of the stadium, if you remember. So it did say the sale contract requires the disposal of the stadium for its fair value of $30 million and for Leria company to lease it back over the 10 years. So on 30th November X6, the transaction would have been executed at $30 million. So the sales proceed, I would rather make it very clear for you guys. The sales proceed would have been $30 million. So our first step was to see if criteria under IFRS 15 had been met, yes or no. Now let's go to the second step. Second step was to calculate PVMLP, present value of minimum lease payments. Now your examiner has already calculated present value of minimum lease payments for you, and that they were, if I'm not wrong, yeah, I see this, they were 26 million. If you see it clearly, it was 26 million. Okay. So yeah, 26 million. This is going to be your lease liability. Whatever your PVMLP is, this is going to be your lease liability. All right. Now let's go to the third step, my friends. So the third step was that you used to calculate RUA. The value of the right to use asset was to be determined by a specific formula. The formula was that you would be using carrying value of the asset before the sale and leaseback transaction and multiplying it by lease liability, dividing it by fair value of the asset. Right? So this was the formula to calculate right to use asset. So basically, out of the total value of the asset, you have retained some portion for your own use. And in that proportion, you have to determine the carrying value of your rights. All right. So working number one, what is supposed to be the carrying value on 30th November X6? What is supposed to be the carrying value on 30th November X6? I would say that we had a carrying value. We just determined that the carrying value of the stadium, the corrected carrying value of the stadium is going to be 20 million. We just determined in part number A, the above part. And that is supposed to be the initial amount that you are going to take from here. I'll just correct it. So that is 20 million. However, remember this 20 million would have been depreciated by 5%. Yeah. So the depreciation pattern was 5% on reducing balance basis. So we are only going to have 95% of its value available. X depreciation. So our calculated value should be, yeah, I would be needing a calculator. Right. So fairly simple. You would take 20 and take 95 of it. So you have carrying value of 19 million. All right. So working number one, you have a carrying value of 19 million of the asset. Now, one thing that you would further require, but rather you don't require anything. You already have rest of the things. So carrying value of RUA can be calculated as you have a carrying value of $19 million of the asset remaining as on 30th November XX. And remember, I calculated this value wrong. Oh no, this could have gone a long way. I would do it simply. So the carrying value on 30th October X5, I did something wrong. I had to take depreciation of 13 months. Yeah. So I would do it pretty simply. Carrying value on 30th October X5 would be 20 million again. Now, remember that we are calculating right to use asset not on 30th October X6, not in 12 months time, but rather we are calculating depreciation on 13-month period, on 13th month period. So we need to be very sure of what we are doing. So I can do it like this: less depreciation for the year ended 30th October X6, and this would be calculated as 20 million into 5%. Now, if you take 20 million into 5%, this is going to be 1 million depreciation. And once you are done with it, you are going to get a carrying value as on 30th October X6, which is going to be 19 million. And then you have to take 1 month's depreciation, 1 month's depreciation to reach at the carrying value on 30th November X6. All right. So this was the mistake that I did earlier. So depreciation for 1 month. And this would be as follows: 19 million into 5%. Since we are following the reducing balance method, we always need to take the carrying value and then apply the percentage. So 19 million into 5% into 1 by 12. And this would be 19 into 5% into 1 by 12. And this would be 0.08. So in short, I am going to have a carrying value as on 30th November X6 of 18.92. I just wanted to be sure, 18.92 million. So 18.92 million is the carrying value, on 30th November X6. Now, as soon as I've got the carrying value on 30th November X6, I can easily calculate the value of RUA. Now, what would be the carrying value of RUA? It would be 18.92 million multiplied by lease liability. So the lease liability was 26 million. And then I would divide this figure by the fair value of the asset. And what was the fair value of the asset? If you remember, the fair value was equal to the sales proceed that we had, and it was 30 million. So 18.92 into 26 divided by 30, thereby you will get an amount of $16.4 million for your RUA. Now remember guys, once you have got the value of your RUA, the fourth and the final step was to make an accounting entry. And do you guys remember what was the accounting entry like? Now remember, when you are talking about sale and lease back transactions, there are particularly two transactions happening: sale and lease back. So one, there is a sale transaction, other, there is a lease transaction. So how do you make an accounting entry for this? Just think of it simply. There are two transactions and I need to combine these two. I need to compound these two. So number one, there is going to be a sale transaction. So cash is going to be debited and your earlier asset which is sold now, the stadium, it is going to be credited. One area is this. And then remember, this is also a lease transaction. So if this is also a lease transaction, then RUA debit and FLO credit, this is also one accounting entry that you need to prepare. And whatever balancing figure that you have on the debit side or the credit side, that is going to be your profit or loss on the disposal. So if we go and complete this transaction, what amount of money that we did we receive from the sale and leaseback transaction? The sales proceed, if you remember it, the sales proceed were $30 million. So we will take the sales proceed of $30 million, recognize the RUA at 16.4. We will de-recognize the assets value at that date, and at that date assets value was 18.92. So the asset is de-recognized from your financial statements. Rather, right to use asset has to be recognized in your financial statements. So asset is de-recognized now. And what about the finance lease obligation? Our finance lease obligation, I remember it was 26 million lease liability. Now, if you see, you absolutely have 46.4 on your debit side, and a lesser value, I would believe, a lesser value on the credit side. And that means you are going to have a profit on disposal. You are going to have a profit on disposal as a balancing figure. So what is the profit on disposal, my friends? Let us just check it out. So 46.4 minus 18.92 minus 26, this leaves you 1.48 million profit on disposal. If you do this much working, my friends, I'm very, 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 very sure that, the requirements marks were 13 marks and you are going to easily achieve these marks. In my own personal opinion, had I been attempting this accounting paper, I don't feel this is a very, very, very harsh requirement. The first two requirements were very easy. You just had to remember what were the requirements of IFRS 5, the conditions of IFRS 5 for classifying an asset as held for sale. Requirement number 2 was just merely in opinion if the accounting treatment was correct or not. You had to refer to IS 37 for a bit. The only time that you would be requiring would be to solve the requirement number 3 of part number A, and for that you might have to use some of your calculator skills. Again, that was not very difficult. In very much stipulated time, I believe that this 13 mark examination requirement was solvable. It was not a very difficult requirement, in my own humble opinion. You let me know how you feel about it. All right, now let's move forward. We are doing part number B, and again in part number B, there are again two requirements for 12 marks. So it is easier, it is simply and reasonable to assume that each of the requirements would have 6 marks each. So let us first read the requirements and then we would go on to the question requirements, to the question scenario. Number 1, whether the amortization of the intangible asset relating to the television program content rights by Leria and by the industry are acceptable policies in accordance with IFRS. We can read this requirement once again. Whether the amortization of intangible assets relating to the television program content rights by Leria company and the industry are acceptable policies. Now, they are talking about the acceptable level of policies for amortization of intangible assets. Now, if you go back and recall, according to IS 38, the accounting for intangible assets was to be based on their useful life. And under the absence of any other reasonable method, we always used to follow straight line method. Now, if the Leria company is following straight line method or any other appropriate method, we can give due credit to it that yes, this amortization policy is correct. And we also need to compare it with the industry practices in order to reach a reasonable conclusion. All right. So now let's go on to study what is the scenario of television program content rights. Okay. Now let's see. It says that Leria company has its own subscription based television station. So Leria company basically owns a television station, and there they produce content, they produce dramas, they produce different kind of shows, and that may be their intangible asset. As a result, it has material intangible assets which relate to content rights associated with the television programs. So whenever they create a drama, they register it so that they have the content rights. Or if another producer actually produces a drama and the TV station actually buys that drama to in order to air it on their television channels, again they buy the content. And therefore, if you're buying the content, this is an intangible asset for sure. All right. It says the budgeted cost of the production are based on the estimated future revenues for the television program. These cost of production are then capitalized as an intangible asset and called content rights. All right. So content rights are basically your intangible asset. Content rights are basically your intangible assets. All right. Remember, this examiner's requirement is not about intangible assets all alone, but rather the examiner wishes to know about your opinion, your discussion on the amortization of intangible assets. So better stick to amortization and spare the intangible asset part here. All right. It goes on to say, the directors of Leria company believe that the intellectual property in the content rights is consumed as customers view the television programs. So the usage of the content rights is basically based on how many times you air this program and how much content is being watched by customers. So it's the content's value life is not merely based on number of years or number of days or number of months. Rather, it is based on how much the content is rated and how much times it is seen by our customers. Consequently, Leria company currently amortizes the content rights based upon estimated future revenues from the television program. Sir, how do they amortize their intangible assets? It's written. For example, if a television program is expected to generate $8 million of revenue in total, and 4 million of that revenue is generated in year one, then the intangible asset will be amortized by 50% in year one. So this is how actually the game works. You take a proportion of the revenue earned today as a proportion of the total revenue to be earned. So for example, your examiner is explaining that, for example, from a content, if we budget that $8 million of revenue will be earned, and you have earned $4 million till now, then that would mean that 50% of the content has already been aired, and therefore 50% it should be amortized. Now, this is the philosophy the Leria company is currently following. However, the industry practice is to amortize the capitalized cost of the program less its recoverable amount, scrap value, over its remaining useful life. So the industry practice is basically to follow the straight line method. All right. So now we need to discuss if this is in accordance with IFRS's policies, yes or no. And here I would like to take the lead and refer to IS 38 for you guys, how I would be writing this answer. And while I'm writing this answer, I'll be teaching you a bit of the requirements of IS 38 as well. All right. So this is requirement number B and requirement number 1. I would say that according to IS 38, accounting for intangible assets is based on their useful life. Under the absence of any other reasonable method, under the absence of any other reasonable method, straight line method should be followed. All right. In this scenario, it's evident. In this scenario, it is clearly apparent that industry follows SLM, which is the default method under IS 38. All right. So the industry is correct in its own regard. So the examiner wanted us to discuss if the industry policy requirements and the depreciation pattern which is being utilized, which is being followed by Leria company, are in line with the concepts of IS or IFRS, yes or no. So as far as the industry is concerned, the industry is following SLM, which is the default method. And unless they have any other more reasonable method to amortize their intangible assets, this is clearly acceptable under IS 38. So the industry part is done. But here, when you talk about Leria company, first of all, Leria company is not following the industry practice, which may be a concern, right? So Leria company is not following the industry practice, which is a concern. Now remember, according to IS 38, in IS 38, revenue based amortization is generally not acceptable. Now this is the teaching part. Remember guys, IS 38, there is a rebutable presumption, that revenue-based depreciation mechanism in IS 16 and IS 38 both, there is a rebutable presumption that revenue-based depreciation pattern should not be followed, because the revenue is largely dependent on variety of factors. What is the demand? What is the season? What is the inflation levels? How the economy is going? What are the likes and dislikes? So basically, the life of the asset is not directly linked to sales. So sales can go up and down depending on how the demand or the social thing works for this program content. You cannot clearly link the life of the asset, from the sociality. So logically, IS 38, generally recommends not to follow the revenue pattern. However, given the nature of the content, it seems logical to link the economic life of content to public views, right? So generally, IS 38 does not recommend you to adopt such an accounting depreciation method which is linked to revenue. It's not preferred. However, in this case, the content is only livable till people watch it. If the people get bored of it, or there is another competition, there is another program launched before you or launched after you, right after you, and it becomes more successful, it seems logical to link the life of the content with public views. To me it seems logical, right? So since this is a discussed requirement, you can talk both sides. You can say that generally it is not acceptable, but it does seems logical if if clear pattern if clear pattern of content life can be explained through past examples, then this amortization mechanism may be followed. Remember, IAS 38 does not restrict you on following a certain accounting amortization model. It says that under the absence of any other reasonable method, you should follow straight line method. But if you have another reasonable method, which seems to be logical in this case, that the program's actual life is actually related to the public views or to the amount of revenue that you budget that you're going to earn and what amount of money that you have actually earned, it seems logical to link it with the public opinion, right? If Leria is capable of explaining the authenticity of such amortization pattern through past examples, maybe it can show some examples where the accounting pattern actually reflected the end of the content's value. So when the amortization was 100% complete, it can be made evident that the content was taken off here or it was not run anymore. If it is provable, then you can say that this may be the logical method to follow. IAS 38 has no issues with regards to it. All right. So generally, industry is on the right track. Generally speaking, IAS 38 does not prefer it, but if a reasonable assumption or a reasonable pattern can be witnessed, this type of amortization pattern can be followed. No problems. All right. So now, my friends, let's move on to the last requirement, requirement number B, part 2. And let's see what is required in this case. Remember, there is one more heading remaining. So it's reasonable to assume that whatever the requirement number last is, this is related to the last paragraph, player's contract cost. Now, your examiner is asking how to account for the player's contract cost, including the contingent performance conditions. Okay, generally, before I even study the content, generally under IAS 38, now this requirement has been asked many a times in P2 and SBR exams, so I know the right answer for this right away. According to IAS 38, if you get the license to use, or if you conclude a contract with a player, then this license or this contract is basically treated as an intangible asset, right? So generally what happens is that most of the times when you hire a big football player, you give them a small fixed remuneration and then you offer them a larger variable remuneration. All right, this often happens. So what IAS 38 says in this regard is that at the date of signing of the contract, that is on the date of initial recognition, an entity should account for the fixed remuneration and also expect the achievability of variable remuneration. So you have to estimate that how much you would have to pay Cristiano Ronaldo by the end of the season, by end of the year, and then you are allowed to capitalize the whole cost. For example, you have given $10 million to a certain football player fixed for the next 2 years. All right. And then you expect that on top of this $10 million, they will be able to earn $30 million in the next 2 years. So the total expected value, the total expected cost of having this player is going to be $40 million. And then this estimated value you will capitalize as an intangible asset. IAS 38 works like that. All right. So let's see how to account for the player's contract cost, including any contingent performance conditions, the variable considerations, any impairment which might be required to these non-current assets, and whether a player can be considered as a single cash generating unit. So basically there are 3 requirements. First requirement is how to account for a player's cost, including the contingent or the variable fees that you will pay them. Number 2 is any impairment that might be required to such non-current assets. So there is IAS 36 in it. and whether a player can be considered as a CGU. Remember, CGU means cash generating unit, means the smallest identifiable asset for which recoverable amount can be determined, for which there are independent cash flows. Now, I certainly believe that a player does not contribute independent cash flows. The whole team works for it, and the whole team earns you cash flows, but not a single player can have identifiable cash flows. So for me, a player cannot be a CGU. Regardless, let's see the scenario. It says that players' registration contract costs are shown as intangible assets and are initially recognized at fair value of the consideration paid for their acquisition. So basically, whenever a football player, any player joins the club, the fair value of the consideration being paid to them is taken as cost of intangible asset. All right. However, subsequently, players' contracts are often renegotiated at a cost, right? So as the season progresses, or as soon as the player has become on board to you, you try to renegotiate the assets value. Okay. The player's remuneration. Also, players' contracts may contain contingent performance considerations where individual players may be paid a bonus based on their success in terms of goals scored or the scores of the football team as a whole. These bonus represents additional contract cost. So I would like to answer the first part right here, right now. Okay. We are talking about part number B and part number 2. So as far as the player's contract cost are concerned, I would say that on the date of initial recognition, an estimated value of the consideration including any contingent consideration should be taken into account. Right? Should be taken into account. So initially your intangible asset is measured at the fair value of the consideration payable. All right. Any subsequent adjustments due to renegotiation, right? Subsequent adjustments may be made to the cost of intangible asset. Why would that happen? As a result of negotiation. Now, I would like to point out this fact here, and your examination kit and your examiner also says this out quite loud, that there is no discussion in IS 16 or IS 38 about such subsequent adjustments to the contract value. Technically, IS 16 and IS 38 both are silent on such scenarios where if you renegotiate the cost of an asset subsequently, where would those subsequent adjustments be made? Now, if a student had gone into examination and said that such subsequent adjustments, since these renegotiations will be made within first few days of the initial contract, these renegotiation adjustments can be made as an adjustment to the cost of the intangible asset, the student would have been right. If any other student would have said that no, any subsequent adjustments need to be recognized in P&L, then that student would have also been right, and this has been noted down by the examiner and your examination kit as well. Both students would have been right, since IS 38 and IS 16 is silent about such things. All right. So this part is done. Now the other area is, your examiner tells you that for impairment purposes, Leria company does not consider that it is possible to determine the value of use of an individual player. it is not possible to determine the value of use of an individual player, because the cash flows are not tied to an individual player. The group or the club will only earn money as a team. It is a team game. It is a game of 11 people. So no individual person would be, doing all the goals, doing all the goalkeeping, doing all the ads, doing all the, all the endorsements and everything. So individual players cannot be considered to have a value in use. That is true. Unless the player were to suffer a career threatening injury and then cannot play in the team. Players only generate direct cash flows when they are sold to another football club. So your examiner asks you any impairment which might be required to these non-current assets. So we would say that impairment cannot be done on individual player unless a particular player is severely injured, in which case intangible asset of that player would be de-recognized. For example, there is one player and that player receives a career threatening injury. For example, that player cannot play football anymore. Well, in that case, there is no impairment. There is direct de-recognition of the intangible asset, because that player is no use for you. You cannot transfer sale that player, and you cannot enforce that player to play for you any longer. And most likely you will not be paying any further consideration as well. So therefore, this is a direct de-recognition of the intangible assets in the case of, a career threatening injury. All right. And furthermore, player cannot be considered a CGU because it does not have directly attributable, directly identifiable cash flows. All right, my friends. Now with this, I've just given you a draft answer of B part number 2. What you can do is you can write down the answer on your level, much in a much more better manner, and have it checked from me. Now, this is a very good question that I would say that would have come as a question number 3 probably in your exam. This is a real life past paper exam. I hope you liked the discussion that we made during this day. And in case of any queries, I'm always available. You know my particulars. You can contact me on 923452745092. You can always find me on LinkedIn, YouTube, and WhatsApp. And just connect with me if you have any queries, and maybe you can send me your answers as well, and I can check you, and I can check and provide you a brief feedback. All right. So my dear students, I believe this was very much helpful for you guys. Let me know in case of any query. All right. Great day.